put these two things together, that weaker dollar and lower rates, and you get a magic elixir that can turn around the whole market. A strong dollar, remember, hurts overseas earnings, and bond yields reflect whether Wall Street expects more pain from the Fed, which is why it's so good when both of these things go down. Before we get into why, though, last time we read an excellent off-the-charts piece highlighting work by Carly Garner about how the dollar could soon peak. She said the dollar was the most, what she called, crowded trade out there, and it would soon do something called reversion to the mean, which would also put a stop to the relentless rise in bond yields. Carly's great. She doesn't waffle. She cuts it straight, telling us that the decline would start now. Sure enough, the dollar got clubbed today, and it looks like it's about to roll over. Now, the dollar and bonds have kind of a chicken and egg dynamic for most people. Hard to know which one follows the other. But Carly explained that the dollar had gotten wildly overbought and was due for a pullback, something that would stop the relentless rise in bond yields in its tracks, too. And that's exactly what happened today. We got the most forceful decline in long-term rates since this long run began. It was a monster fall in rates, which frightened everyone who was betting on rates headed higher. That's not a great bet, given that we won't have anything that would spur another increase in rates until the Fed meeting on November 2nd. For now, we're in what's known as the blackout period, where Fed officials can't speak, and it's been a godsend for the market because these Fed presidents and governors love to come out and terrify you with talk of napalming the economy with a series of massive lockstep rate hikes. They know nothing! I know if I were in the Fed, I'd bring all these people together and say, hey, explain. You guys are all assistant coaches. And I would tell them that the only guy who should really speak is Powell. The Fed as an institution tries so hard to be careful about what it tells the public. Then these officials just spew whatever the heck they feel like. It's insane. No way to run a central bank. Without any interference from them, though, we were devoid of the discordant voices, and that frees us up to speculate on what stocks would look like if both the dollar and bonds are telling the truth here, meaning the two-year Treasury can't stay above that key 4.5% level. It's having a hard time breaking through to 4.75. Remember, that has been the battleground of late, and maybe 4.5% is just a bridge too far. Perhaps there's so much recession chatter that it simply makes no sense for short-term bond yields to keep climbing.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.